Imagine walking into a room where billions of pounds are moving at the speed of thought, where one decision can make or break fortunes in the blink of an eye, and where talent is measured not by resumes but by results. Now, imagine that the brightest minds from one of the world's most powerful hedge funds left everything behind to build something entirely their own. And in just 2 short years, they have rewritten the rules of success. Tonight, you're going to see how a single firm went from an ambitious startup to paying its top performer a staggering 78 million pounds while amassing billions in assets, attracting elite talent and dominating markets in ways few even thought possible. This isn't a story about luck. It's about precision, strategy, and the relentless pursuit of excellence. Hold on tight, because what you're about to witness will redefine everything you thought you knew about hedge funds, ambition, and the kind of rewards reserved for those who dare to think bigger than anyone else. When people talk about success in this industry, they often focus on outcomes, the numbers, the headlines, the payouts. But real success is almost always decided much earlier, long before the first trade is placed. It begins with pedigree, discipline, and the courage to step away from comfort in pursuit of something sharper, leaner, and more intentional. The origins of Ex-Citadel are not accidental. This firm was built by individuals who were trained in one of the most demanding environments in global finance, a place where every position is scrutinized, every risk is measured, and every decision must justify its existence daily. That background matters. It shapes how you think, how you build teams, and how you design systems that don't just survive volatility, but exploit it. Wow. Keying away from a dominant platform is never easy. It means giving up scale, infrastructure, and certainty. But it also creates something far more powerful: accountability. When you start from scratch, there are no excuses. Performance isn't hidden behind layers of bureaucracy. Culture isn't inherited, it's engineered. Every hire reflects intent. Every dollar of capital represents trust that must be earned repeatedly. That is the mindset behind Ex-Citadel. From day one, the focus wasn't on being the biggest firm in the room. It was on being precise, on building a structure where decision makers are close to risk, where incentives are aligned, and where excellence is not diluted by complacency. The founders brought with them not just experience, but scars. Lessons learned from markets punish arrogance and reward preparation. This pedigree also sends a signal to investors. Capital doesn't follow narratives, it follows competence. When allocators see leadership that has operated at the highest level, managed complexity under pressure, and delivered through multiple market cycles, confidence compounds quickly. That's why growth came fast. Not because of marketing, but because credibility travels. Equally important is how that background influences culture. In elite environments, performance is not an aspiration. It is a baseline. Everyone understands that compensation is not guaranteed, titles don't protect you, and yesterday's wins mean nothing tomorrow. That philosophy carried over. The firm was designed to attract people who want responsibility, not shelter. People who thrive when expectations are clear and standards are uncompromising. There is also humility embedded in that journey. Leaving a powerful institution reminds you that no system is invincible, no strategy permanent. Markets evolve, talent migrates. The only sustainable edge is adaptability combined with discipline. That awareness shows up in how Ex-Citadel operates, cautious where it needs to be, aggressive where conviction is earned, and always grounded in risk management. In the end, the story of Ex-Citadel foundation is not about rebellion or ego. It's about continuity of excellence, taking a proven philosophy, stripping away inefficiency, and rebuilding it with sharper incentives and tighter focus. That is how enduring firms are born, not from noise, but from experience. Conviction and the quiet confidence that comes from knowing exactly what it takes to win. Growth in this business is never an accident. It is earned, measured, and often misunderstood. People see assets rising and assume momentum. What they miss is the discipline required to scale without losing control. Because capital, when mishandled, doesn't just dilute returns, it exposes weakness. Our challenge is not attracting money, it's proving every single day that you deserve to keep it. When a firm grows from a modest base to managing billions in a short span of time, that growth is a verdict. It reflects investor conviction that the process is repeatable, the risk framework is credible, and the leadership understands what breaks firms at scale. Capital allocators today are not sentimental. They have lived through cycles where speed destroyed judgment and size masked fragility. They allocate to those who demonstrate restraint as much as ambition. What makes rapid expansion meaningful is not the headline number, but the timing and quality of the inflows. When capital arrives in concentrated waves, it is often a response to performance under pressure. Markets over the last few years have been unforgiving. Volatile rates, geopolitical stress, crowded trades. Growing through that environment sends a clear message. The strategy is working when it matters most. But growth also tests culture. As assets increase, complexity multiplies. Trades get larger. Liquidity constraints become real. Risk no longer hides in theory. It shows up in execution. That is where many firms stumble. They confuse confidence with capacity. They scale strategies that worked at one size without adapting them to another. The result is erosion, not expansion. The firms that succeed approach growth with skepticism. They ask hard questions before accepting capital. Can this strategy absorb more without distorting returns? Can the team maintain intensity? Are systems built for tomorrow's STR? Not yesterday's success? Saying no becomes just as important as saying yes. That discipline is invisible to outsiders, but it's the foundation of sustainable growth. Investor trust compounds when growth is paired with transparency, clear communication, realistic expectations, no theatrics. When allocators understand how capital will be deployed, how risk is managed, and how downside is controlled, they commit not just money, but patience. And patience is the most valuable currency in volatile markets. Rapid asset growth also creates leverage beyond capital. It attracts talent. High performers want to work where momentum is real, where leadership is decisive, and where opportunity scales with results. That virtuous cycle reinforces itself. Better talent drives better outcomes. Hedge in turn justifies further growth. But none of this works without humility. The moment a firm believes growth is guaranteed, markets will correct that assumption brutally. Expansion must remain a byproduct of excellence, not its objective. When growth becomes the goal, standards slip. When excellence remains the goal, growth follows naturally. Ultimately, the story of expansion is not about speed. It's about control. Growing fast while staying disciplined is one of the hardest things in finance. It requires leadership that respects risk, understands capacity, and never forgets that capital is rented, not owned. Firms that internalize that truth don't just grow, they endure. Compensation is one of the most misunderstood signals in finance. To outsiders, a large number looks like. To those who understand performance-driven organizations, it looks like alignment. Pay is not a reward for presence, it is a consequence of impact. When compensation reaches extraordinary levels, it doesn't happen in isolation. It reflects value created at scale. A payout like £78 million is not about generosity, optics, or bravado. It is about outcomes. It represents decisions made under pressure, risk assumed with discipline, and results delivered when markets offered no forgiveness. In environments where one wrong judgment can erase years of progress, exceptional performance is rare, and when it appears, it is priced accordingly. High compensation also sends a clear internal message: results matter more than hierarchy. Titles don't earn rewards. Tenure doesn't earn rewards. Performance does. That clarity sharpens organizations. It attracts individuals who want accountability, who believe their skill can move the needle, and who are willing to live with the consequences of their decisions. When incentives are structured correctly, ambition becomes productive rather than destructive. Critics often miss another point. Large payouts usually coincide with even larger value creation elsewhere. Investors don't fund compensation, performance does. If one individual is paid at that level, it's because investors, partners, and the firm itself have already benefited disproportionately. That's not imbalance, that's alignment at work. There is also a strategic dimension. In modern markets, talent is the ultimate scarce resource. Capital is abundant. Data is abundant. What isn't abundant is judgment, the ability to interpret noise, size risk correctly, and act decisively. When a firm demonstrates that it will reward that capability without hesitation, it becomes a magnet for elite performers. That competitive edge compounds over time, but compensation at this level also carries responsibility. When you are paid like a top performer, you are expected to operate like one, consistently, transparently, and with restraint. There is no room for recklessness, no tolerance for shortcuts. The bar doesn't lower after success, it rises. That pressure is part of the contract. Importantly, these outcomes don't emerge from short-term thinking. They are built on systems that track risk meticulously, attribute performance honestly, and avoid the temptation to smoot. Results. In firms where compensation truly reflects contribution, numbers don't lie, and neither does accountability. There is a deeper cultural signal as well. Paying for excellence reinforces a meritocratic identity. It tells every person in the organization that ceilings are not artificial. That opportunity expands with results, that if you generate real value, the firm will stand behind you fully. That belief fuels intensity, loyalty, and focus. In the end, record compensation is not the story. It is the evidence. Evidence that the firm's structure works. Evidence that incentives are aligned. Evidence that someone delivered when it mattered most. Markets don't hand out rewards arbitrarily. They allocate them ruthlessly. And when compensation reaches historic levels, it reflects a simple truth: extraordinary results demand extraordinary recognition. Profit is the most honest scorecard in this business. It has no patience for narratives, no tolerance for excuses, and no interest in intentions. When profits rise sharply, especially in a difficult market environment, they reveal something fundamental. A firm understood risk better than its peers and executed with discipline. When conditions were unforgiving, a surge to 9-figure profitability in a single year does not come from a single trade or a lucky stretch. It comes from systems working in harmony, research that challenges assumptions, portfolio construction that respects correlation, and risk management that is active, not theoretical. Profits at that scale are the result of thousands of decisions made correctly, and just as importantly, countless bad decisions that were avoided. What separates durable profitability from temporary success is repeatability. Markets change, regimes shift. What worked last quarter may fail the next. Firms that generate consistent profits build processes that adapt without losing identity. They don't chase every opportunity. They focus on areas where they have informati, ownal advantage, execution strength, and the ability to size risk precisely. Strong profitability also reflects operational maturity. As firms grow, inefficiencies multiply. Costs rise. Communication slows. Controls weaken. Maintaining margins while expanding requires constant pressure on the organization. Pressure to simplify, to automate intelligently, and to eliminate anything that doesn't directly contribute to performance. Profit growth in that context is not passive. It is engineered. There is also a psychological component. Profitable firms earn the confidence to stay patient. They don't need to force trades to justify existence. They can wait for asymmetry. That patience is often mistaken for caution, but it is actually strength. It allows capital to be deployed when probabilities are favorable rather than when boredom sets in. Profitability at scale, ALS. O changes external perception. Investors become more discerning, not less. Expectations rise, scrutiny intensifies. Every drawdown is examined, every deviation is questioned. Firms that continue to deliver under that spotlight demonstrate resilience, not just in markets, but in governance and communication. Internally, profit creates responsibility. Success raises the standard for everyone involved. It removes excuses. When resources are available, performance must justify them. Teams are expected to refine, not relax, to innovate without destabilizing, to improve without compromising risk controls. It's important to recognize what profit is not. It is not validation that risk can be ignored. It is not a guarantee of future success. Markets have a way of punishing complacency faster than inexperience. The most profitable firms treat strong years as stress tests passed, not immunity granted. Ultimately, sustained profitability is the outcome of humility paired with confidence. Confidence in the process, humility in the face of uncertainty. Firms that understand this don't celebrate profits as an endpoint. They treat them as fuel to reinvest in talent, technology, and discipline. In an industry where fortunes can reverse quickly, profit is the clearest proof that leadership, culture, and strategy are aligned, not for a moment, but for a full cycle. And that alignment, not the number itself, is what separates firms that flash briefly from those that endure. Every great firm reaches a moment where success attracts attention and attention attracts talent. But not all talent is equal. The difference between firms that plateau and firms that redefine their ceiling is their ability to identify, attract, and integrate people who raise standards rather than simply fill seats. Strategic hiring is not about expansion, it is about reinforcement. When experienced professionals choose to join a young but fast-growing platform, they are making a calculated decision. They are leaving familiarity for potential. They are betting that the firm's leadership understands how to deploy talent, protect autonomy, and reward contribution without politics. That decision is never driven by compensation alone. It is driven by belief in the platform and confidence in the culture. Elite hires change more than headcount. They change tempo. They bring new perspectives, and risk, execution, and market structure. They challenge legacy assumptions. They identify inefficiencies that insiders no longer see. When integrated correctly, this accelerates evolution without destabilizing the core strategy. When integrated poorly, it fractures trust. The margin for error is thin. That is why intentionality matters. The most effective firms do not hire for reputation, they hire for fit. They ask whether someone elevates decision-making under pressure, whether they respect risk as much as return, whether they can operate independently while remaining accountable. These traits are not visible on a resume, but they determine outcomes. Strategic hiring also sends a signal to the market. When respected professionals move to a platform, investors notice. Counterparties not. ICE. It reinforces the narrative that momentum is real and sustainable. Talent flows toward environments where it can do its best work and where leadership has the clarity to let it. However, growth in talent must be matched with discipline and structure. Adding strong personalities without clear governance creates noise. Successful firms define authority precisely. They protect independence at the portfolio level while enforcing firm-wide risk controls. That balance allows creativity without chaos. There is also an obligation that comes with attracting top performers. You must provide them with tools, data, and decision frameworks that justify their move. Talent without infrastructure is wasted potential. Investment in technology, analytics, and operational support is not optional. It is the cost of relevance in modern markets. Equally important is succession thinking. Firms that last do OT rely on a single star. They build depth. They develop future leaders who understand the culture and can carry it forward. Strategic hiring accelerates that process by injecting experience into the pipeline and setting new benchmarks for excellence. Ultimately, the purpose of hiring is not growth. It is resilience. Markets will test every firm. Strategies will face drawdowns. Confidence will be challenged. Teams built with intention respond with analysis, not panic. They adapt without abandoning discipline. In the long run, capital follows talent, but talent follows leadership. Firms that attract the best do so because they offer clarity, fairness, and accountability. They create environments where performance is visible and rewarded, and where ambition is matched by responsibility. That is how organizations transform short-term success into lasting institutional strength. And now, as we step back and look at the rise of this extraordinary firm, one thing becomes crystal clear. This isn't just a story about numbers, payouts, or market dominance. It's a story about vision, conviction, and the relentless pursuit of excellence that refuses to settle for ordinary in a world Here opportunities vanish in an instant. where markets test every assumption and where only the bold thrive. The founders of this firm prove that audacity paired with discipline can create something truly extraordinary. A single top performer earning 78 million pounds, billions in assets under management, and a culture built on merit, precision, and absolute accountability. This is what happens when talent meets opportunity at the highest level. So ask yourself, are you ready to think bigger, move faster, and demand more from yourself than anyone else expects? Because the world rewards those who act decisively. And the story of Ex-Citadel is a reminder that extraordinary success favors the fearless. This is not the end. It's only the beginning. The markets will continue to challenge, the stakes will rise, and the bold will continue to define the rules. And for those watching today, the question is simple. Will you be a spectator, or will you be part of the next story that shocks the world?